Anthony Lawler grew up in South Africa and has an MBA from the University of Chicago's Booth School of Business. He joined $78 billion GAM Holdings in late 2011 and is global head of portfolio management, where he serves on the investment committee to the Alternatives Investment Solutions business. He expects that investors will continue to increase their allocations to alternatives.
Hedge fund performance has been disappointing, but I think we're at a point in the cycle where expected returns on equities are not very bullish. Expected returns on bonds are low, something like 2.5%. And so I think when you look at those comparisons, it's likely that people are going to continue to look to alternatives, including hedge funds, to try to diversify where they get their expected returns from, even though the expected return or the experienced returns in hedge funds have been underwhelming in the very short recent past. So what we see from pension funds and other allocators is even in the face of that performance, they are looking very seriously at increasing their allocation to alternatives. One thing that is changing is in such a low rate environment, there is a lot more pressure on fees. Taking the old standard 2 and 20 out of a return stream that is challenged because of very low volatility and very low rates is difficult. And so what we see is investors putting a lot more pressure onto reducing the one known when you go into an investment, which is the fees that you pay. And so we think that's a very reasonable, rational response from investors that we are ourselves supportive of. We spend a lot more time working with our end investors on understanding their broader portfolio needs and concerns, and understanding with them and with looking at the data, how we can best deliver a solution that has the highest probability of improving their portfolio profile. So that means that we're doing much less off-the-shelf product and much more custom solution approaches, whether those be portfolios of hedge funds or longer duration trades that are customly designed for that investor, or reconstructing the underlying trades, what people are calling alternative premia, or a set across all of those. And so I think it's much more bandwidth intensive and much more customized. That's probably the biggest change that we've seen.